Well, good morning and welcome to today's class. Our topic today is on risk management, all the development finance institutions and risk management. So allow me to share my screen. In our previous lesson, remember we covered we were looking at the central bank supervisory framework, and we went through the CAMELS, or the rating system that is normally used by the banks. And the need for doing that was to be able to understand or appreciate the ability of management to control and monitor risks, including the credit and the interest rate risk at the central bank level, which is the bank, or which is the bank of the other commercial banks. So today I want us to look at the development finance institutions and how they mitigate, or how they are able to put into perspective the risks that might hit them. And by definition, all we know that risk is a situation involving exposure to danger. When you are not certain about the implication of an activity, we talk of a risk. So when we are talking with respect now to something that humans value, we'll be talking of all the perspective of business. Is where now the future, we know that everyone will start a business, of course, to get a profit. But the converse can happen. So equally, you can get a loss. So any business that it's outside there and really looks into ensuring that they perform the activities well cannot profile or cannot operate without putting into perspective any danger that might hit them unexpectedly. So they'll start by doing what we call the SWOT analysis. So they'll be looking at the strengths, the weaknesses, any opportunity that they can exploit, of course, the threats. And it is the threats that now make these people, it is the threats that make these people have a risk monitoring tool to cushion themselves against any danger or any uncertainty. And human beings are inherently selfish, and they wouldn't want to be hit by a danger. So they'll always cushion themselves against any opportunity that might hit them uncertainly. So risks are usually defined by the adverse impact on profitability of several distinct sources of uncertainty. So while the types and the degree of risks of an organization may be exposed to depend upon a number of factors, could be size, complexity, the business activities that you are engaged in, how big or how voluminous your business is, etc. Generally, banks will face credit risk, market risk, liquidity risk, operational, or what we call the compliance risk, and reputational risk. If anything happens, you can imagine customers take their money to the bank or the deposit taking institutions at the back of their mind, knowing that this is a safe custody. So you can imagine a situation where the financial institution cannot account for the money that the customer deposited. Well, they may refund this money, but the reputational risk is immense. If that information goes outside there, it can easily damage the brand of that bank. So most banks will make sure that they protect or cushion themselves against any manner of tarnishing the brand. So before overarching the risk categories given, there are some basics about risk management and some guiding principles that need to be put into perspective to manage the risk in any banking organization. So we are talking of risk management as a human activity which integrates a recognition of risks. So you should be able to assess and have an idea or develop a strategy that will be able to mitigate us against any risk that might hit us as a business. So the strategies is up and including transferring the risk to another party, avoiding the risk altogether, reducing the negative effect of the risk if we are hit, and accepting some of all the consequences of a particular risks. And we have the conventional risk management that focuses on now stemming the risk stemming from the physical or the legal causes. We do have the natural disasters or calamities, or what we call in insurance the act of God, accidents, deaths. We may have legal and litigation cases, name them. So particularly, I want us to put into perspective the financial risks and their management. So financial risk management focuses on the risk that can be managed using the traded financial instruments. So the objective of risk management here is to reduce different risks related to the pre-selected domain to the level accepted by the society. And this may affect numerous types of risks caused by either the environment, could be technology advancements, we have the humans, organizations, or even the politics. For example, like right now, you know what we are going through. The BBI, we have the pro, we have the anti-BBI, we have the campaigns. If anything happens that might affect the politics of the day, that may impede on the business principles or how the businesses are regulated, it will momentarily affect even the forecast or the profits that businesses had. For example, if we get, let's say, new taxes means that the businesses have to meet that obligation. If they had not forecast this when they were doing their financial planning for the year, it will affect their income or the profits that they are going to report, and vice versa. So even politics of the day will really impede, or it may affect the operations of the business, hence are political risks. So on the other hand, the financial risk management involves all the means available to the human being, all that you can exploit. If you scan the environment and there is a way that you can maneuver or manage your risks, either through your personnel or the way you manage your staff, the organization, the way you cushion yourself against any legal or the compliance issues, you can manage. So in every financial institution, risk management activities broadly take place simultaneously at the three levels. We have the strategic, we have the macro and the micro levels, or what we call the tactical and the operations level. So when we are talking of the strategic level, this encompasses risk management functions that is performed by now the senior management. So it is really a corporate governance issue. So for instance, the ascertaining the institution risk appetite and formulating a strategy or a policy for managing such a risk and ensuring that we have adequate systems and control that can detect or ensure that we are not hit. And if we are to be hit, we'll have cushion or we'll be aware. It will ensure that the overall risk remain within the acceptable level and the reward compensate for the risk taken. So you'll find most institutions, they have what we call the risk monitoring tool. And in the risk monitoring tool, each responsibility center is expected to identify their strengths, what are their opportunities. They should also identify their weaknesses, because for you to understand whether there is a threat or not, you should be able to know the areas that you are not good in. And of course, what are the prevailing uncertainties? And these are the ones that we are calling the threats. So the risk can be monitored and they can put or place these to be, some institutions will be doing it quarterly, others are doing it semi-annually, others annually, depending on the magnitude or the operations of the institution. They can even do it daily. Some institutions are very risky. And we are talking of a financial institution where if you err even one day, it can go or the effects are far reaching. So at the tactical level or the macro level, this encompasses now the risk management within the business area or across the business lines. So generally, the risk management activities here are performed by the middle level management or the units that are devoted to risk review and fall into this category. We can have what we call the internal audit. And the purpose of the internal audit is not really to antagonize the operations of the business. Rather, it's supposed to be for value addition. Then we have the compliance department that should be in a position to, at any point in time, ensure that the policies of the institution are being adhered to. Because the lapse in the adherence to the compliance is what will now expose the business or the business unit into unexpected or an uncertain activity, which is a risk altogether. Then at the operations level or the micro level, this involves now the people who are on the front line. So when we are talking of the risks that are actually created when the business activities are being concluded, this is the risk management activities that will be performed by in the day-to-day operations by for example, if you take a deposit-taking financial institution, if the cashier at the till or the cashier's till is not keen on what we call the KYC or the know your customer, the basic canons of identifying the customer, they may end up, I can come over the counter with someone else's ID. Of course, I've stolen their data, so I know their account and transact or withdraw money over the counter. So there are those critical activities that the cashier and the till should be able to perform. For example, they can quickly collate the image in the system versus the face. What if I have a twin brother or a look-alike and I get the identification documents and come? So further, they can go at the signature level. What if I forged the signature? They can take it further by asking some questions like, when did you last do your, let's say, when did you first do your withdrawal? Which ATM? Can you recall? What amount? You see, they can easily detect whether they are dealing with the right person. You may have seen in some instances when you are going to deposit, especially large amounts of money over the counter, the cashier leaving the cashier's till and going to the back office. They may be doing this to buy some time and try to see whether you'll be, or you see human beings, they have a way of detecting when there is a risk. So if you realize that the customer or the cashier has gone to the back office, could be they are going to do some checks and balances. If you are a fraudster or you had come with an intention to forge, you may be agitated and leave. So that way the cashier will have saved the situation. Don't know whether you are getting. Then you have the credit risks. Now, credit risk is the risk of loss due to the debtor's non-payment of a credit. So when the bank is doing the underwriting or when they are drawing the credit facilities, they are supposed to do a comprehensive assessment to show cause that this customer will be able to pay. Imagine a situation where you are employed. Let's say your institution has what we call the scheme loan. Scheme loan is a situation where your employer is now they are like your security. So you are not supposed to render any collateral to the bank for you to get the credit facility. Your pay slip guarantees that you'll be able to pay. What if, let's say, you access a credit of 5 million, then something happens in your institution and you are laid off next month? What will happen? The bank will have exposed itself to a risk of not being paid the 5 million. So when we are talking of the credit risk, this may arise from the potential of the obligor, either unwilling to perform, and some employees are so shrewd. I know that I'll be resigning next month. So I approach my employer, of course, we'll be having a good relationship. I get a loan of like 2 million, go buy a car, and then I know very well that I won't be paying for this car. So I got the credit facility, not as an asset finance. So I go buy a Subaru, then next month I dish out my resignation letter. So there is no way that the bank can reach out to me and take the Subaru because the security was my payslip. Are you getting? So it is good to cushion yourself, or the bank in its portfolio. They should ensure that losses that stem from the outright default due to the inability or the unwillingness of the customer to pay or meet the commitments are well taken care of, because this can really injure the performance of the bank. And we know right now with the comprehensive guidelines and regulations from the CBK, if a facility defaults 30 days, you're supposed to issue what we call a loan arrears notice. Second month, that is 60 days, you're supposed to issue what we call a symphony bond. Then at the end of the third month, that is the 90th day, you're supposed to dispatch a formal demand. And at this point, the financial institution, because they are unable now to collect the debt and it is defaulting for the third month, they are supposed to be seeing these provided for as an uncertainty in your balance sheet. You can imagine the scenario when we had the COVID and the central bank governor with the president, in consultation with the president, requested the financial institutions to offer what they were calling the loan holiday. Of course, the banks were torn between, now, should we stop these loans altogether and stop the interest from accumulating? We had forecasted for this interest that they will be recouped in the year that we are trading in. What will happen? It was very serious. So no sooner than the 3 months moratorium ended, than most of the banks now started even threatening their customers. that you need to start paying your loan altogether. And whatever was being called loan holiday, very few institutions were able to do this, or customers were able to negotiate for this. Remember, your loan was still incurring some interest. So it was not a holiday per se. So alternatively, losses may result from reduction in portfolio value due to now the actual or the perceived deterioration in credit quality. So when we are talking of the credit risks, it will emanate from a bank dealing with the individuals, the corporate, or they could be dealing with the sovereign, or what we call the self-autonomous, or the other financial institutions. So they should be able to cushion themselves against the same. Then we have the market risk, and this is the risk that the value of on and off the balance sheet positions of a financial institution will be adversely affected by movement in market rates or prices. Things such as the interest rate, we have the foreign exchange rates, which is a quagmire. When we are talking of the now accounting for the price level changes, and you are trading cross-border, you have the holding of the parent companies that operates from overseas, and they have their subsidiaries across different territories. They should take this into account. So when we are talking of the balance sheet activities, yeah, we are talking of the equity prices, credit spreads, commodity prices resulting in a loss due to earning and capital. So financial institutions may be exposed to all these market risks in different ways. So when we are talking of the market risk exposure, maybe explicit in the portfolios more so of the securities and equities and the other instruments that are actively being traded in the securities market. So equally, it may be implicit, such as interest rate risk, which is internal, yeah, due to the mismatch of the loans and deposits. So when you are doing the underwriting and some of these facilities, they are negotiated. If you are doing negotiated instruments where, depending on the turnover of the account or depending on the relationship that you've had with the customer, if at some point you evaluate or underwrite a customer not in the cluster that you thought they were, you'll have exposed yourself against the market risks. So beside market risk may also arise from activities that are categorized as off the balance sheet items. Things like letters of credit. Some institutions will be coming for what we call the bid bonds if they are tendering, revolving underwriting facilities, long-term capital, name it. We call these off-balance sheet items. Therefore, market risk is potential of loss or for losing resulting from the adverse movement of the market risk factors, such as the interest rate. You've talked of the cross-border transactions, equity, commodity prices, etc. And you know that the prices of these commodities, they are pushed by the market forces, the demand and supply level. It is not something that you can really forecast or tell. Now, liquidity risk is the next category of risk. So liquidity risk is the potential for loss to an institution arising from either inability to meet its obligations or to fund increases in assets as they fall due without incurring an acceptable cost of losses. You've seen 3 banks in this country being put under receivership by central bank because they were unable to meet their day-to-day operations. So when we get an institution, a financial institution, getting to a position of not being able even to pay their employees is very serious. So the liquidity risk may arise when the cushion provided by the liquid assets are not sufficient enough to meet its obligation. So in such a situation, banks often meet their liquidity requirements from the market. Reasons because the regulator, now the Central Bank of Kenya, they have set a ceiling where all the banks are supposed to be to ensure that they are able to meet this part of risks. But we have those unscrupulous managers, of course, who will have underdealings or try to be clever. And that's why we were talking of the corporate governance. When we are talking of the camels, we say that supervisory or the supervision, the management, carries the biggest burden in ensuring that the financial institutions are not hit by what we are calling the liquidity risks, by ensuring that all the measures and balances are put into play. So when the banks experience rapid growth in assets, they should have major concern for their liquidity risks, because this can easily hit them. It's a trigger if they are not able to identify and monitor at the right time. Then you have the operational risks. And when you are talking of the operational risks, this is the risk of loss resulting from inadequate or failed internal processes. And this is where the internal audit comes into play. So the compliance or the legal department should ensure that employees, they are sensitized, or the awareness is there on how they are supposed to cushion or how they are supposed even to perform the activities. You can imagine an employee who keeps on printing unnecessary materials using the company's printer consistently, or if we have such 10 employees, it could be a risk. Because if, let's say, one employee is using, let's say, half a rim, 2 employees will be using a whole rim. So you can see how exponential it is if most of these employees are not sensitized on printing only what is important to them. And that's why the technology is there. An institution should ensure that their systems or the way they do operate is so efficient such that you don't have what we call the idle time. If you are able to save on the idle time, the business activities that will be carried out in this time that we are saving will translate into income. So we'll be cushioning against ourselves against any risk that may hit us in operations. So operational risk events, the types have a potential to result in substantial losses, which includes either internal fraud, external fraud. If internal customers note that the internal audit, for example, there are those people who are given the powers or the duties and the responsibility of managing petty cash. And petty cash could be meant to meet some of the loose tools or the operations of the company. But if this particular employee realizes that they are not asked to account back for the money, either by receipt or source documents, they can easily take advantage of the situation, and this money will be going into the activities that were not planned for. Also, the fraudsters, once they identify that we have a weakness in the checks and balances or the compliance in that particular institution, they can easily defraud, or they can easily chip in and do an activity that will injure the operations of the particular institution. So sensitization and the compliance, and that's why most institutions ensure that they are ISO certified. The way they do their business is in a particular manner. It is systematic. Maybe wondering why we have a lot of bureaucracy. For example, if you go to a public university, before you reach the vice chancellor, it may take you even 2 weeks. And the secretary knows that the vice chancellor is in the office. But because there are other offices that are supposed to serve you, why should you come directly to the VC? So you'll be either asked to do a letter and book an appointment. And then, of course, that letter, they'll be doing another letter on top of it, sending you back to the, let's say, the departmental level or otherwise. You get. So these systemic failures is because of lack of a due process. And that's why we have the business process engineering. And most businesses are trying to adopt this to ensure that they save on efficiency, to ensure that the operations and everyone is responsible at their point in time. So I'll not be exposing myself because I know I'm liable for any infraction that I'll do as an employee. So managing operational risk is supposed to be through any employee who is working for that organization. And they should understand that even their fellow employees can put them in their situation or in a mess where they can easily end up being jailed or something of the sort. Then we talk of the currency risk. And when we are talking of the currency risk, it's a form of risk that arises from the change in price of one currency against another. And this will normally hit on cross-border or the businesses that operate on different territories. So whenever investors or companies have assets or businesses operations across the territory, they may face the currency risk if their position are not hedged. And that's why we have the hedging. If, for example, you are trading in dollars, and when you come back in the country, you have a Kenya shillings account, chances of losing when the dollar is misbehaving to the local currency are very high. Are we there? So if you are doing a cross-border, you should ensure that you are trading or you hedge yourself against any loss that may hit you. The other kind of risk in this particular category is the transaction risk. And this is the risk that exchange rates will change unfavorably over time. And this may be because of inflation or things that you cannot cushion yourself against. So if you are in forward contracts or futures, if it is not well hedged, you may end up losing at the point of transaction. Then we have the translation risk, and this is an accounting risk that is proportional to the amount of assets held in foreign currency. And changes in the exchange rate over time will render a report inaccurate. And so assets are usually balanced by borrowings in that currency, the domicile currency. So the exchange risk associated with a foreign denominated instrument is a key element in foreign investment. And this risk flows from differential monetary policy and growth in real productivity, which result in different inflation rates. And last but not least, we talk about the interest rate risk, the IRR. And this is the risk that the relative value of an interest-bearing asset, for example, a loan or a bond, will worsen due to the interest rate increase. So in general, as rates rise, the price of fixed rate bond will fall and vice versa. So interest rate risk is commonly measured by the bond's duration. The oldest of the many techniques now used to manage the interest rate risk. But of course, our financial system has also become progressive, and they are able to forecast they are doing sophisticated trend analysis to ensure that the interest rate risk was set on the interest-bearing assets. It will not injure if the prices fluctuate, because this will worsen the situation. So they ensure that before the IRR is set, it is informed by different or indicators that are measurable. So if we have the key performance indicators, they'll easily know when they are wavering, because they'll be able to identify and tell after a duration of time, let's say 1 year, 2 year, 3 year, 4 year. This is a situation that we had. These were the KPIs, the key performance indicators. And because they were not well observed, we were hit. So what are we supposed to do as an institution? So while setting the IRRs is very key, because this will now determine how you will be able to manage the interest rate risk if you are hit. So when we are talking of the uncertainty about the implication of any activity with respect to something that humans value, we are really talking about the risk for the business. So I want to end it there. For today, I want us to go and transact our business in the portal. There is a discussion forum that I want us to respond to. There's also a journal. In 300 words, I want you to respond to the item in question. If we don't have any concern, I beg to end it at this point. We transact from the portal. So I want to wish you a good day. We will end our class for today at that point. Thank you.